Let's now delve into the key focus of today: global investing for South African investors. This question around how much foreign assets is enough is one we get quite often, and we actually get it more often when the domestic economy is going through a few jitters, or when the local market is down, or when the rand is weak. But the reality is that this isn't a optimistic versus pessimistic view on South Africa, and it's not a tactical thing that we include or not include into the portfolios, and it's not a market view or an economic call at all. It's actually a financial planning decision at the core of it. This question should rather be answered by what the client's objectives are, how long the client wants to stay invested for, and how much volatility the client can stomach in the short to medium term. But before we answer the question and try and get to that magical number, I do think it's important to take a step back and ask ourselves, why does global investing matter? Why must we as South Africans consider including assets outside of the country in our portfolios? Yes, it sometimes feels like you want to take the money out of the country if the economy is going through a dip or if there's a political instability, but that's not the real reason. That's not the key driver of why it's a good idea to include the foreign exposure in your client's portfolio. Including foreign assets gives your clients exposure and diversification to so many other sectors beyond what the JSE offers, the Johannesburg Stock Exchange. It gives you access to broader growth opportunities. It gives you access to so many other regions and countries that grow at different rates than what we do. At times, it will give you access to more attractive valuations, and it'll also give you access to different currency movements, different behaviors of the currency in the short to medium term. And all of this combined, if you think about it like this, including the offshore exposure or foreign assets into your portfolio, will result in a more resilient, more steady, low volatility portfolio because of diversification. It will change the risk and return profile of your client's portfolio. Because the reality is for us as South Africans is that our gross domestic product or our economic activity is less than 1% of the whole world's economic activity. So if you were to invest your clients only in South Africa, you're accessing such a small part of the world's economic activity. If you do include foreign assets into your portfolio, you can think about it as you accessing the other 99% of the world's economic activity in your client's portfolio. The concentration of South Africa is even more evident if you look at it from a sector level. Another way you can think about it, or another way you can position it to your clients, is that around 70% of the world's most valuable companies operate in sectors that don't even exist on the domestic stock exchange. Semiconductors, biotech, artificial intelligence, cloud infrastructure, software. These sectors are at the forefront of global growth. These are some of the themes that's expected to grow, to provide the most growth to the global economy over the next few years. Yet the only way you can access this for your clients is through investing in foreign assets outside of the country. So let's say lesson number one, or point number one for today, is why do we include offshore exposure? It's not a call against South Africa, but rather it's a growth enhancement, and it's a very efficient diversification tool for your clients. But there's a bit of a complexity around it. If you include foreign exposure into your client's portfolio, it's not as simple as what did the US stock deliver that I invested in, how much did the stock price go up. You also have to consider what the currency movements are. And a way to think about it, and a way to position it to clients to make sure that they understand how foreign assets behave, is this concept of the two engines of the foreign exposure in your portfolios. Whenever you take money out of the country and you invest in an equity or a bond that's outside of the country, you're effectively taking two positions. You are going to get the return of the, let's call it US stock that you bought, and you're also going to get the return of what the rand did compared to the US dollar. And on the screen now, we've put the scenarios or the permutations that can play out. You will either have your global investment in, let's call it dollars, perform well, or maybe not. It might be down in the short term or the period you're measuring it over. And on the other hand, you'll have the currency either strengthen or weaken. Now, the good news is that the most painful scenario, which is listed here, which is the equity market is down and the rand strengthens, detracting from your rand performance, is actually the least likely outcome. From an economic perspective, from how things tend to behave, from how we expect things to behave, you'll most often sit in the good, average, and even excellent scenario. Because what tends to happen in how equity markets in particular and the rand move together is that if the global equity markets are up and things are positive and there's risk on sentiment in the world, then money tends to flow to South Africa. We're one of the most liquid emerging markets, so we're one of the first currencies that gets bought if there's a risk on sentiment. But that demand for our currency brings the price of the rand down, or it strengthens the rand. So what you often find happening is global equities are up at the same time that the rand strengthens, and this rand strength detracts from your rand performance for the client. The other common scenario is weak global equity markets. So global equity markets are down. Usually it's when risk sentiment is in a risk-off environment. So capital is now leaving the emerging markets. We're the first one to lose the capital. The rand weakens, but that actually protects your rand performance of the offshore assets. And then you do get scenarios where global equity markets are up over the same time period that the rand weakens. But it is important that clients understand that there's two drivers to the performance of this part of their portfolio. And I think it's also maybe useful for clients to understand, but what does actually drive the rand? And the reality is that very few of the factors that drive the rand and how it behaves to the likes of the dollar and the sterling and the euro actually has nothing to do with our domestic economy and our domestic political situation. Global risk sentiment is a key driver. Global risk sentiment determines where the money is coming in or out of the country. And as I've explained, money coming into the country strengthens the rand and money leaving the country weakens the rand. Interest rate differential also determines whether or not capital is coming in or out. If our interest rate or our real rate, so the rate you can earn above inflation, is attractive, we will find more money coming in because there's a demand for the yield. But let's say the US Fed hikes rates before we do, and there's a period where the US interest rate is more attractive than our interest rate, then the money won't come in, and we will most likely find a period of weakening currency. The commodity cycle is a very, very key driver of the rand performance. We are a commodity-rich net exporting company, so high commodity prices, booming commodity cycles is good for the rand, and vice versa. Commodities in a downturn, the rand tends to weaken. South African specific fundamentals do also impact the currency. Yes, if we have load shedding or political unrest, you will see short-term jitters. And then the other key driver is the US dollar cycle. Specifically now, we're in a weakening US dollar cycle with Trump in power. And that's, of course, a positive for us from a rand perspective because the rand is strong. And it's a bit of you can't have your toast battered on both sides. I don't even know if that's a proper English saying. I'm just translating directly because the strong currency is good for us as South Africans. It keeps our inflation under control. Prices are lower, but the stronger rand has a negative impact on the dollar performance converted into the local portfolios. I thought it could be useful to look at how did these things behave together over the last 20 years? What has this relationship been like? And on this chart, I just show you the per calendar year in the bars, what the dollar performance was of the global equity market. Then in the dots, I show you what was the rand performance. The green dots indicate that the rand weakened, which added to the rand performance of your foreign assets. And the red dot is an indication of rand strength, which, as I said, is good for us as a country. It helps us as a consumer. But in your portfolio, the stronger rand detracts from your rand performance. As you can see, no painful emojis. And more often than not, it's either the yellow or the green. So 2025, 2016, 2007, strong global equity markets, but also strong rand. And then you've got a few periods like 2013, where you did have rand strength alongside the strong global equity markets, and periods like 2008, of course, where the rand played a very important role protecting you against the downside of the global equity market. It's also quite interesting to zoom in to two specific periods, again, just to get clients comfortable and familiar with how these assets tend to behave together. On the left-hand side, I've got the first quarter of 2020. So over this period, the global equity markets fell as low as 33% at a stage in US dollars. But over the same period, the rand weakened by the same amount. So you'll see the green line, the lighter green line at the top, which is the rand performance, completely protected clients against the downturn in the global equity markets. Of course, over the same period, the domestic equity market fell by 35% as well. So here again, you can get a sense of how having both dollar-denominated equity and rand domestic equity helped you from a diversification perspective because of the currency movement driving these two to perform differently. So you had protection from your foreign equity exposure in a period where domestic equity was weaker. Last year, the opposite happened. We had very strong performance from the global equity market, up 22-25%, but the rand was very strong. We had commodity prices up, we have the dollar weakening, we have domestic sentiment being pretty good, and here you can see the opposite happening. You can see that the rand performance of your strong global equity market being lower because of the rand strength. But again, in the same period, your domestic equity market was exceptionally strong, up more than 40%, diversifying what your clients are getting from their equity building blocks. Now the next question, or the question we often get is, can you time the rand? Can you predict the rand? The short answer is no, not reliably. Most professional investors can't even get this right. And as you can see here over this on this chart, which is just a long-term indication of how the rand's moving to the dollar on a daily basis, a lot of movement, long periods of strength, long periods of weakness. But the one thing that we can say is over the very long term, 5 years, 7 years, 10 years, the rand will weaken to the US dollar. We are an emerging country. We usually run a higher inflation than the US. We grow slower than the US. And as a result, our currency is expected to weaken over time. So that's the one thing that we do know. So if you're running a 10-year portfolio, if you're looking out for a very long period, yes, the rand will weaken. Yes, the rand is likely to add to your performance in rand terms. But in the short to medium term, a lot of volatility. Let's look at it on a calendar year perspective again. Here you can see no predictable pattern, no specific way the rand moves. We've had periods of weakness, strength, few years of weakness, few years of strength. The rand really is predictable, and it can cause quite a lot of volatility in the short to medium term. So I suppose now the question is, what can you do? What can you control? How do you have this conversation with clients? We do know that yes, including foreign assets adds to the client's diversification. It offers growth over the long term, but we can't time the rand. And what we think is a useful way or a very practical way to approach this conversation with clients is to go through 4 key questions. So you want to know where will the client spend their money? You want to know when they will need it by. You want to know what their risk appetite is like for short to medium term movements. And then, of course, what wrapper or vehicle will the client use for the specific investment? Now, where the client will spend their money matters, because if you want to spend rands in 10 years' time, if you want to retire in South Africa, you do need to match your domestic liability. You do need a portfolio that can grow in excess of the domestic inflation. So you will need enough domestic bonds, domestic equity that can outperform the SA inflation. Yes, you can include offshore exposure to enhance your growth, but there needs to be a sense of a match between where you're growing your money versus where you're going to spend it. The flip side is also true. If you have a client that wants to retire somewhere in euros, a home bias or South African bias won't work well for that client, because it's unlikely that rand investments will be able to keep up with European inflation and European value. So there needs to be a bit of a match or an awareness of where the client will spend the money. The time frame matters, because as we said, there's volatility in the short term. A client that needs the money in 1 year's time shouldn't be putting their assets 100% into US cash, because imagine that was last year. The rand strengthened 15%, and your client is then forced to lock in that loss and take a 15% loss in that investment. So very important to have an awareness of the time frame. The shorter your time frame, the less currency exposure you should probably have in your portfolio. In a similar fashion or a similar thought process goes to the risk tolerance. You really want to avoid a client panicking and thinking, oh, I can't stomach this up and down of the currency volatility, and sell at the wrong time. So you do want to make sure there's a match between what your client can go through versus the amount of offshore exposure that you're including. And then lastly, sometimes simply the vehicle will make the decision for you. So retirement annuity, for example, which is compulsory money, is capped at 45% under Regulation 28. And the same client that maybe has only 40% in the retirement annuity can very well have a suitable allocation of 60% in their discretionary portfolio. So then is an element of what is the vehicle? Is it a unit trust? Is it discretionary? Is it compulsory? That will also drive that decision. Unfortunately, I still can't give you the one single number. And we actually believe that it's not about whether it's 36, 38, 42, or 25%. We don't think that should be the question or the problem you're trying to solve, but rather about avoiding getting it completely wrong and just make sure you're in the right range. What's an example of getting it completely wrong? A client that does have a 20-year time horizon saving for retirement only in 20 years' time, you don't want the client to only sit in domestic assets. You don't want the client to miss out on the growth and the diversification that the offshore portfolio can offer. And as I said, a client with a 1-year time horizon shouldn't be sitting in dollars only, because the currency can move against you quite quickly. So focus on that part. And then as long as the exposure is roughly in the right range and the portfolio is constructed sensibly, it doesn't matter whether it was 36, 38, or 40. And it's more about, am I getting enough growth when I have the time to grow? And am I aware enough of the volatility that I can introduce with currency exposure in more sensitive periods like drawing an income or maybe the transition into retirement savings? I do have a bit of good news for you today. I'm completely not giving you any answers. I think the amazing thing about worrying about whether it's 36, 38, or 42% is that there's many investment vehicles and funds that can take that worry away for you. The Select Fund of Funds range, for example, each of the underlying asset managers do that every day. They think about, must the assets be invested in South Africa or in a different region? If I take the money offshore, must it be in equities or bonds? Should I invest in America, UK, or Europe? We can outsource that decision to experts that manage it every single day. And the great thing about the Select Fund of Funds range is each of the underlying funds that we hold within Select do manage the money with an awareness of clients saving for retirement or clients already in retirement. What I've put up on the screen for you is a reminder of how much direct offshore exposure each Select Fund of Funds have. They are all allowed to go up to 45% in the Reg 28 part of the range, and of course global equity 100% offshore. And then the other thing to keep in mind is, yes, there's an element of direct offshore exposure that the managers take on, but there's also companies like Anheuser-Busch that the managers invest in the domestic equity market that gives you that additional exposure to global markets. And the other thing that I find quite interesting is you'll see the awareness of the time frame within the offshore exposure between defensive and growth, for example. So defensive sitting at about 32% direct offshore exposure. It is a 3-year fund. It is a fund that can't lose capital over a 1-year period, compared to growth that's sitting at 38% because it's a 5-year fund. It can stomach a bit more volatility in the short term for that extra growth. So to end off, I would say the 3 key things I want you to take out of today's session is global investing isn't a bet against South Africa. It shouldn't be something you try and run away from. It should be a structural part of your portfolio to give you access to other markets and diversify your exposure. The currency cannot be predicted. The rand cannot be predicted. Rather plan for it, by making sure that the amount of offshore exposure you have is suitable to your client's appetite and to your time frame. And then lastly, be patient. Good outcomes for clients will come from staying the course in the right portfolios for the right time frame. I really hope you found this discussion useful and that it's something that you can use in your next client meetings around global investing. I'm now going to hand over to Steve, who will give you a bit more insight into how Dodge & Cox is seeing the world. Where are they finding value? Where are they seeing risks? And what are they excited about for the Dodge & Cox Global Stock Fund? Thank you so much, Steve. Over to you.